The Fed just declared rates under 6% for the first time since 2022. And what does that mean to you? Who cares, right? Well, I got a video here that shows exactly how that affects you if you're a buyer, how that might affect you if you're a seller, and all the ups and downs and where we're going from here. So anyway, stick with me. At the end, I'll talk to you a little bit about everything else. So what the hell does that even mean? All right. By the way, I'm Saul Carter, business sense, common sense, uncommon realtor. That's how I like to do things. And let's talk about interest rates and how that actually affects your mortgage payments. So in the Thousand Oaks, Simi, all this range, kind of the median sales price, Thousand Oaks is about 1.1 million. In Moore Park's about 850. And same like Simi Valley is around that same range. Getting over into the Westlake and whatnot, your median price is about 1.6. Obviously, you can spend more, you can spend less. And I've got some numbers here for you. Now, this is not legal advice. This is just examples to give you some education on exactly how this affects your mortgage payments if you get yourself in now under the current system. It was today, the day that I'm recording this video, which is February 26th, 2026, that the Fed declared for the first time, like I said, since 2022, that rates are now on the average at 5.98%. That is a huge, huge deal because that gets us a lot closer to where things used to be in that 3 range, which honestly is free money, right? 6 is still a really good rate. I would accept that, but that's where we're at. So I've got 3 scenarios. I'm just going to go through the math real quick for you on kind of how much it affects you on your mortgage payments. So I've got some assumptions. We're assuming that we're going to do a 30-year fixed. We're going to do a 20% down, and it's going to be principal and interest. So I'm not going to talk about insurance, all these other things. We're just talking about the principals and the interest, not insurance or taxes. So your payments will be a little bit higher depending on where you're at and what your interest rate or your insurance rates are. And obviously your taxes are assessed and those get wrapped in there into a mortgage if you have a mortgage. So we're going to do with the first example, $850,000. You put 20% down, that means your loan amount is $680,000. If we were a few months ago, when rates were at that 6.5 range, that means your mortgage payment per month would be $4,298. Okay, today, right under that 6, let's just call it 6 to be nice and even. The Fed said it was a 5.98, but at 6, your new mortgage payment with mortgage principal and interest only is $4,077. That is a $221 per month savings, right? And what does that mean to you per year? That's $2,653 per year they're saving just from that 0.5% of mortgage rate. Now, let's talk about the next price range that I kind of referenced, and that is the 1.1, 1.5. I'm going to go $1,050,000 for this one. If you do that, and you're 20% down, like I said, your mortgage is going to be $840,000, and your interest payment at 6.5%, or your mortgage payment at 6.5% is $5,309. That drops down when you get in that 6 range to $5,036, which is a $273 a month savings, which on annualized is $3,278 savings, right? So that's pretty good. Now let's talk about this other larger loan. So if you get a house, you buy it for $1.6 million, your loan amount is $1.28, and these are just examples. But your mortgage payment, assuming 20% down, is going to be $8,900, right? Which is a chunk. Now, if it drops down to 6%, your new mortgage payment is going to be $7,674, right? And that is a monthly savings of $415 and annualized savings of $4,995. Now, that's a huge savings. That means that if you've been sitting on the sidelines, this might have gotten you into that range where you can start to not sit on the sidelines. If you are a seller, what this means is the actual reverse holds true. So let's say you have somebody who at their 6.5%, they can only afford a $3,800 mortgage. They can now jump in there and afford that $4,000 mortgage. Same with the person that is buying something and they could only afford that, $4,500 mortgage or $4,600 mortgage. They are now going to be reaching in to that area because before that 6.5%, now they could only, let's say, afford $5,000. Now that they're at that 6%, they can afford that higher mortgage amount, which means that there are going to be more buyers in those ranges at higher amounts. If you look back in history, a lot of the price increases for sellers was really an inverse relationship for interest rates. It's not even necessarily the value of the home, and I know we all think that our home is the most valuable one in the world, but it has a lot to do with affordability and what people can afford to pay in those interest rates. So the lower those interest rates go up, the higher you start to see those prices go up. And so dipping below that 6% range is an awesome place to be. And I'll say, the same holds true at any price. If you have somebody who can afford at this level, but the interest rates go down, that means their new level drops, but that means they can afford that one, so they can actually raise that price up accordingly and be able to look at newer property that they have not been able to look at for, let's say, a year ago, right? So what does that mean? That means that there's going to start to be even more activity, especially since there's news about this literally today as I'm recording this video. What's funny about this is I worked this up literally 2 weeks ago, and I'm just coming to it, and it just so happened that on this day is when the Fed announced that those interest rates nationwide just dropped between 6%, below that 6% range. So, my advice, look into it. You might have found yourself at a place, if you've been looking, 2 years ago or a year ago, that you're just, I cannot do this. You might find yourself in a place where you can now. And it's a good time before, like I said, as the people get used to those lower interest rates, that means that the prices might start to go up. And so you were kind of this little sweet spot where you can get into that property and the prices have not gone up yet. So it makes it a little bit more affordable and you can get that house, whether it's first time move up or you just time for a new house, right? So that's where we're at. If you need more tips and tricks, don't normally do videos just about a whole bunch of math, but get with me. Let me know if you have any specific scenarios you're looking for and subscribe, and I will talk to you soon. Thanks.